Hey everyone, Meet Kevin here. Oh boy, today we had some big old inflation readings coming through CPI again. A lot in the space of travel and hospitality and used cars, and the numbers were way bigger than expected. We were expecting 0.5% month over month. We got 0.9%. We were expecting 4.9 on the year over year. We got 5.4%, worse than last month. To help me try to unpackage what the heck is going on, I figure we reach out to somebody who has a lot of experience talking about inflation, and that's Peter Schiff. So I'm going to go ahead and bring Peter Schiff on. Thank you so much for coming back, Peter Schiff. Welcome aboard.
Hey, how are you? I'm just trying to send a note to have somebody let people know that I'm doing this thing live here to get some more people watching.
You are live, and not only are you live, but the cool thing is you are actually in a hotel right now, which is one of the things whose cost just skyrocketed, at least according to CPI. So tell me a little bit, where do you stand right now?
Well, I'm in a Swiss hotel, so we got a different rate of inflation over here. Of course, when the U.S. dollar really tanks against the Swiss franc, it's going to be a lot more expensive for Americans to stay in hotels pretty much everywhere. I guess the dollar is going to go down against a lot of currencies. But look, we got some horrible news today on consumer prices for the month of June. Right? Once again, I think this is the sixth month in a row for the year. Every single month, the inflation number has come out much higher than it was expected. And so this month continues that trend. They were looking for prices to rise by 0.5%. They rose by 0.9%, almost twice the estimate. It was the biggest monthly gain of the year, right? They told us that the big numbers that we saw earlier in the year were transitory. Well,
I think I lost you there for a sec. I think the Federal Reserve is coming in and is cutting off Peter Schiff's connection at the moment. I'm sure we'll get Peter Schiff back in just a moment. This is interesting. 6 months in a row here of essentially the argument of, hey, transitory inflation. We'll get Schiff, Peter right back here. This is what happens when Jay Powell comes in with the internet, the internet police. But anyway, we'll get Peter back in a moment. I really want to hear Peter's perspective here because it's very insightful. And to think about it, yeah, the last multiple months have been a big problem with inflation. So we'll get Peter reconnected here in just a moment. And let's see here. Peter is in Europe right now, which is fun, is Europe Pacific capital. So I guess it makes sense to also be in Europe. But we'll get Peter reconnected here. Looks like we're working on establishing that connection right now. So Peter will be right back. But yeah, it's a good point. You know, when you put it that way, it is interesting. Month over month, you've had almost a double the expectation. We had the expectation that inflation would come in at 0.5, came in at 0.9 with CPI. A lot of folks don't even believe CPI. Now, I'm going to ask Peter when he comes back, and I want to leave it open for your questions as well. But I want to know from Peter, why is the bond market not reacting yet? And we'll have some more questions. See, it looks like we're almost reached. There we go. Peter, the Fed cut you off, man. What is this?
No, it's not the Fed. I think it has something to do with the storm. We're having a huge lightning storm. I don't know if you can see in the windows behind me. It's all rain. But
I didn't know the Fed could control weather already.
They can't control anything.
All right, let's hear it. So you were just saying 6 months of high inflation.
You know, that reminds me of the joke. Why did God invent economists?
to predict 20 of the last 2 recessions?
No, to make weathermen look good. But so get what I was saying is that if you take the inflation for the first 6 months measured by the CPI, we're up 3.7% in 6 months. That's already closer to 4% than 2%. But if we just repeat the first half of the year in the second half, we're going to have a 7.5% increase in consumer prices. Except the second half is going to be worse than the first half because a lot of businesses have been reluctant to raise prices. They're going to throw in the towel because they were thinking it was all transitory. So they didn't want to just, jack up prices. So they're going to raise prices. But also, I was just listening even to what's his name, Jeremy, pointing out on television that, you know, housing is 60% of the CPI. And according to the government, housing prices are only up about 2% year over year. And that's the reason that the CPI isn't up even more. Now, we all know that's nonsense. This is the biggest gain ever for home prices in the U.S. And it's not just home prices. Rents are skyrocketing. But the reason is because the way the government measures housing costs is they use owner's equivalent rent. And what that is they do a survey and they ask people, hey, if you were to rent out your house, how much do you think you would get? Right? They don't know. So these numbers don't move. But maybe by the end of the year, people are going to start to realize how much rents have actually gone up, even though they're not paying them. And they might come up with some bigger numbers. So we could easily end up with a official CPI rising by more than 10% in calendar year 2021. Now, if that is the case, is the Fed still going to say it's transitory? Probably. So we may have to wait another year, and maybe we'll get 15% the following year. Everyone's cost of living is going to skyrocket. And then when the Fed finally has to admit, I guess we were wrong, it's not transitory, well, they can't do anything about it. It's much too late. What are you going to do about 10, 15% inflation when interest rates are at zero? It's not like you could just raise them to 50 basis points and you're going to stop that inflation, juggernaut.
Why do you think bond yields are falling? Now, we know the Fed's buying $120 billion a month, which is crazy, but they've been doing that for more than a year now. And now we're still seeing rates starting to fall since about, April, May. We're seeing them fall down. And even today, they didn't spike that much more. I mean, the 10 years like 1.36. It briefly went up to 1.38. What's broken here? What's happening here?
Well, because bond traders expect the Fed to do the impossible. See, I think what the bond market is forecasting is that the Fed is going to have to admit that it got it wrong and that inflation is a bigger problem than it thought. And therefore, the Fed will have to start tightening up on monetary policy sooner than everybody thinks. And so the bond market is looking forward to tighter monetary policy and the fact that it's going to slow down the economy or maybe put it into a recession. And so the bond market is starting to factor that in because it thinks the recession that is going to follow Fed tightening will put an end to inflation. That'll solve the inflation problem. And so the bond market is forward looking and factoring that in. But what the bond market doesn't understand is that the Fed isn't going to fight inflation because it can't, because inflation would win. Even if it tried to fight inflation, it wouldn't just cause a recession, it would cause a depression. It would cause a worse financial crisis than 2008. And that would cause the Fed to print even more money. So if the Fed tries to fight inflation and in the process causes a recession, we'll get even more inflation as the Fed tries to stimulate the economy out of the recession. So when the bond market figures out that inflation is not only going to be a lot worse than the Fed thinks, but that the Fed is going to do nothing about it, which means it's going to keep getting even worse, the bond market's going to get eviscerated. And of course, eventually, the government, the Fed, is not going to sit back and watch interest rates skyrocket and the entire house of cards that it's helped direct come tumbling down. So the Fed is going to intervene. It's going to increase the size of its quantitative easing. Everybody is talking about now, hey, when is the Fed going to taper? When are they going to start buying fewer bonds? The reality is they're going to start buying a lot more bonds because the rest of the world is going to want to get rid of their bonds. And the only one left to buy will be the Fed. And the only way they can buy is by printing even more dollars that nobody wants.
Wow. So I'm going to try to unpackage that a little bit. So it sounds to me like you're saying one of the reasons yields are actually going down is because at least with the way the bond market is looking at what's happening now is they're seeing, okay, well, a taper is going to come. If a taper comes, maybe that means our bond prices, because we'll have, how would that work? I mean, that wouldn't. I mean, if the taper comes, that means we'd have less buying demand. Prices would fall, though. So if they're anticipating the taper, maybe I'm a little lost there on the connection there.
They're anticipating that the Fed's tighter monetary policy, even though it would still be very loose, it would just be less loose than it is now. They think that's going to slow down the economy or put it into recession, and therefore that will bring down prices and ultimately cause the Fed to cut rates again, right? So they're looking to the whole business cycle. And of course, if you are a bond investor, you want the Fed to fight inflation, because inflation is the worst enemy of a bond holder, because it's eroding away the value of the principal that you are expecting to be repaid in the future. So as a long-term bond holder, you want the Fed to fight inflation. And that's exactly what they expect the Fed to do. They are wrong. Now, it's like they think the Fed is going to admit that it made a mistake, right? Oh, we thought inflation was transitory. It turns out it's not transitory, so we're going to have to fight it. The Fed did not make a mistake. They lied. I don't think anyone at the Fed believes inflation is transitory. I think they know it's permanent, but they also know they can't do anything about it, so they have to lie and pretend. But now, they're not going to fight it in the future, because it's going to be an even harder fight in the future. The longer they wait to fight inflation, the harder it gets, because the bigger the inflation monster becomes. And since fighting inflation means raising interest rates, the longer they wait to raise rates, the more debt that we have when they do it. And so the more vulnerable the economy is to the only weapon that they could use to fight inflation.
Well, why do you think it seems like banks aren't buying as many bonds as they have been? They're hoarding more cash. They're using the reverse repo operations to park their cash overnight. Well, why are banks holding cash? What's going on here?
Well, they're not really holding cash. They're just lending their cash to the Fed. They're buying U.S. Treasuries. What they don't want to hold are corporate debt. They don't want to hold, higher yielding bonds from banks, private banks, not the Fed, or corporations. And the reason is because the yield is not high enough. The spread, the extra income that they earn by taking the added credit risk, right, is not worth it. Because if we're going into recession, that means a lot of these bonds are going to go into default, because a lot of the issuers aren't going to be able to repay. And since the yield premium is so slim, the banks want to play it safe. They want to put their money with the Fed, because at least they know there that they're going to get it back, because the Fed's not going to default, because it's got the pretty press. But having a pretty press in the big scheme of things doesn't mean much, because they print the money till it has no value. But it shows you that the banks are worried about credit risk. Why are they worried about credit risk? Because they're worried about recession.
That's interesting. So tell me if this bottom line is right. So the bond market's trying to price through the entire cycle. So they believe that in the future, the Fed's going to have to come back in after the taper and after a disaster. The bond market is pricing in the fact that the Fed's going to have to come back in, buy a ton more bonds, creating more demand for the bonds that they now own, driving up the prices of those bonds again in the future.
Yeah, I mean, they're looking past. They're like, okay, the Fed's going to step on the brakes. The economy is going to tank, or going to be back in recession. Then they're going to have to, launch more QE. They just expect that the Fed can keep doing what it's been doing. Because if you look at all of the past cycles, the Fed prints a lot of money, causes an asset bubble. Eventually, they raise rates or something happens. The bubble pricks, and then everything collapses and they start all over again by slashing rates. But every time they cut rates, they have to go lower than they went before. Well, we're at zero now, so you really can't go any lower. Then they started QE, but every time they do QE, they have to do bigger than they did before. Just like drugs, when you're doing drugs, you need more and more of the drug because you build up a tolerance. The bond market assumes that we could just do this indefinitely. They're wrong. The Fed is going to destroy the value of the dollar, right? We're going to overdose on this QE. And when the dollar is destroyed, bonds are destroyed. That's what the bond investors don't get. Bonds are just future, payments of dollars. And if the dollar is losing value in the present, then dollars in the future are even less valuable than the dollars today. And that's what bondholders are holding. So we are headed for a massive sovereign debt crisis. And again, not just sovereign debt, but bonds. The big losers are going to be the creditors, the bondholders, the people who have cash, the bank, the people that have fixed annuities, cash value, and an insurance policy. Everybody's getting wiped out here, right? The winners will be the owners of assets and the debtors that have assets but also owe money against those assets. But of course, the biggest losers will be the average American worker who's totally screwed. Although the retirees are going to get screwed the most, right? So if you're my age, I'm 58, if you're thinking about retiring or you're already retired and you've just got a pension, an annuity, some Social Security, I mean, you're completely screwed. You're just going to get wiped out. At least if you're a 20-year-old, you don't have much to lose as far as your retirement savings. But we're going to be living in a much poorer country. And, so real wages are going to just implode in the United States as a result of this inflation. And, Americans are not going to be able to take their paychecks and buy all these products from China and places like that because they're not going to be selling those products for our dollars anymore.
Why do you think the dollar market's not falling yet if the markets are trying to look forward to this?
Same thing. I mean, they're not looking forward to this. They're not looking forward to reality. They're looking forward to fantasy, just like the bond market. The dollar market, right? See, the dollar traders think, aha, inflation is hotter than the Fed thought. The Fed is going to be raising rates sooner than later. They're going to be tapering, and that is supposed to be bullish for the dollar. And so this is just all in an algorithm, right? These commodity traders or currency traders, they just program their algorithms, and anything that means rates going up sooner is bullish for the dollar. That's why it's so perverse. If the inflation numbers that would have come out early this morning were lower than expected, the dollar would have tanked. The dollar rose because of higher inflation. And that may seem counterintuitive because higher inflation means the dollar is losing value faster than we thought. Right. So if the dollar is losing value faster, why would you want to buy more of them? Why would you want to pay more for something that's losing value even faster? It's because of what investors expect the Fed to do as a result of that. But they're wrong. The Fed not going to do that because they can't do that because people aren't connecting the dots. What would happen if the Fed actually raised rates to fight inflation? The markets would crash, stocks would crash, bonds would crash, we'd be in a recession, and then the Fed would cut rates back to zero. They would print more money. So if they try to fight inflation, they end up having to create even more inflation. So they're in a situation where fighting inflation is impossible. The only thing the Fed can do with inflation is fuel the fire.
Now, in the CPI this morning, they mentioned that 1/3 of the increase came from used cars. What happens when? I
think it was the biggest increase in the history, and it's the third month in a row. But it's like, the biggest gain ever for used cars and used trucks. Yeah. So
what happens when people have their used cars or these supplies catch up and all of a sudden that turns into deflation? Isn't that going to pull the whole index down?
If used car prices stop going up?
Yeah.
Well, it depends on what else is happening. Other prices are just starting to rise. But I mean, used car prices go down, but the way they're measuring them, it's not the same car, right? Like if I buy a used car today, obviously the price of that car is going to go down. But what they're measuring is the price of used cars from this point in time going backwards, right? Not like, hey, obviously cars depreciate every year. So if I buy a car this year, right, it doesn't mean it's more expensive. So if you bought a used car last year and hey, prices are up, that doesn't mean you can sell your used car for a profit, right? Because now that car is even more used than when you bought it. It's what are the prices of a car that's 1 year old, right? Any given day. So I don't think we're going to see a big drop in used car prices, because I ultimately think we're going to see a big increase in new car prices. And as long as new cars are going to get a lot more expensive than the alternative, a used car, and if the dollar really tanks, which is what I think is going to happen over the next few years, a lot of our used cars are going to get exported, right? They're going to be put on ships and sent to Asia and places like that. So think about how expensive used cars are going to be when Americans have to start competing with the Chinese to buy those cars.
Gotcha. Speaking of which, what do you make of the latest drama with the Chinese coming in to, basically bag on Didi conveniently 2 days after they went public? Is this potentially going to create issues with the Biden administration, and could it lead to just more drama on the markets at the same time all this madness is going on with inflation?
Yeah, it is kind of interesting. I mean, I guess they didn't want to do it before they came public because they wanted to make sure the dumb Americans bought the stock first before they did something to crash the price. Because obviously they could have done this before the IPO.
They timed that so spitefully.
They waited. They waited for the Americans to get in. But look, we manipulate the markets too. So I don't know that we could throw stones at the Chinese.
Okay, fair. So, I want to know this. Housing prices, we're seeing, obviously, asking prices are at all-time highs. I was just looking at some charts, and I'm noticing that housing prices are at all-time highs, and they're ticking up, which usually in the summer they tick down a little bit. They're actually ticking up. The listing prices are up. The number of homes coming on the market is going up, but pending sales is going down. Do you, all of a sudden, we have a shift going down on pending sales? Do you expect any kind of larger real estate shift? And could a real estate shift have an impact on the rest of the market? Or is it more likely that the Fed tries to raise rates and that hurts the real estate market?
Well, if they raised rates, it would crush the real estate market, right? That's one of the reasons they're not going to do it, right? And they would crush all the markets. But I think that real estate represents a great inflation hedge for a lot of people. Okay. Especially when you can buy real estate with very low down payments. Now, the people that don't have any money for a down payment, if you look at starter homes, people, I think, those aren't even there. The supply of those is like at a 50-year low. Yeah. And so you can't even buy those. But, people who have some money and they want to figure out where they can put it to hedge against inflation, buying a house makes a lot of sense. They take on debt that's going to get wiped out to inflation, and rents are going to go way up. And so, if you own your place, obviously you're not charging yourself rent. Your utilities are going to go up and things like that, but you pay those, even as a renter, you still generally have to pay your utility bills. But it's an asset that, inflation is driving up the cost of building houses. And so the value of the houses that have already been built goes up. I mean, if the cost of replacing the houses, right? How much does it cost to build a house? If the cost of building a house doubles, then fewer people will build houses. They'll want to buy the houses that are already built. And so then the prices of those are going to go up. I mean, everything is going to go up. But of course, it's not just the price of the house that's going to go up. It's the price of everything inside it. I mean, the prices of the stuff in the refrigerator are going to go way up too. I mean, this is massive inflation. And this is the consequence, not just of, what's happened under Biden, but what happened under Trump, what happened under Obama. We have been printing money for years, decades. And a lot of those inflation chickens are now just starting to come home to roost. But there's a lot of them out there. And so we've got a lot of catching up to do. People have been scratching their heads wondering, why has inflation been so low? Well, it's not going to be low for long. And then it's going to average out and people are going to say, oh, gee, we actually had a lot of inflation. It just got, pushed backward. But we're going to catch up. So all those years of low inflation, now we're going to have a lot of very high inflation. And it's going to average into a much higher period. But the bigger problem is, how do you stop it? How do you turn off the spigot? Because you can't. I mean, under Ronald Reagan, when Paul Volcker was Fed chairman, and he was in a situation where he was looking at inflation spiraling, 20% interest rates was what it took to put out the fire. Now, this is going to be an even bigger fire. The problem is, how are we going to bring an even bigger hose? how are we going to take 25% interest rates? We got so much debt, we can't even get 2%. We don't even think we can handle 1%. But how are you going to put out a 10% inflation fire with a 1% interest rate? You can't do it.
That's interesting. I want to ask you on wages, and this is a big part of inflation as well. The suggestion is that if you remove the wages of the hospitality or reopening sectors, and so you're just left with service and the non-reopening sector, wages are only going up about 0.1%, which is like 1.2% annualized. What's up with that? Is it unfair to take out the reopening sector? Is it just a matter of time before service starts blowing up? Because we haven't really seen that service price inflation yet.
Well, I mean, first of all, I think prices in the service sector are going up. I mean, look at restaurants. I mean, they're raising prices, but a lot of them are doing other things. I talked about this in my podcast. You have restaurants that are now imposing minimums. So if you at a restaurant, it's like $100 a person minimum. So that might not count as a price hike because the menu prices, but they're forcing you to spend more money, or they're just going to charge you a supplement. A lot of restaurants now are, non-refundable. If you cancel the reservation with less than 24 hours, you got to pay. So there are a lot of things that restaurants are doing to increase the cost of dining out that aren't even showing up in the official CPI numbers. But I think costs are going up a lot in the service sector. I think once the capacity really comes down, and I think you're going to see a lot of capacity removed from the market, a lot of restaurants are never going to reopen. They close and they're going to stay closed. And so it's not like when we fully reopen, we get back to normal. If the restaurants have a lot less competition in the reopened economy, well, they can charge higher prices. And, I think still there may be some social distancing going on for a while. The restaurants may not be packing in as many customers. They still may keep people more spread out. And therefore, if there's fewer people in a restaurant, cover all the costs, they don't have as many people to spread the fixed costs over. So that's going to get more expensive. But a lot of the retailers, a lot of the stores have gone out of business. They're not coming back. So I think the wages are going up. And of course, these government benefits, I think, are going to continue to increase. These generous unemployment benefits, stipends, they're now talking about making stimulus payments automatic. So I don't even have to vote for them. Like if something happens bad or the unemployment rate picks up, there's automatically more checks mailed out to everybody. So, but I think the government is going to keep incentivizing people not to work. And therefore, in order to entice somebody to work, businesses are going to have to be paying higher wages. And that's going to necessitate higher prices because the wages are a cost of doing business. And those costs have to be borne by the consumer. And if the consumer can't bear the costs, then the company has to go out of business. And that's going to happen in a lot of circumstances too. But the companies that stay in business are going to be paying higher wages, and their customers are going to be paying higher prices. But as is generally the case, when you have high inflation, and we're going to experience very high inflation, labor prices in general don't go up as much as goods prices. So even though you're getting a raise, and I read a lot of articles about the so-called silver lining of inflation because, you're going to get a raise. Yeah, maybe you'll get a 5% raise. But if your cost of living goes up 10%, the raise is meaningless. It's 5% of your income. But some people get fooled by the numbers. They say, oh, look, I'm making more money. Yeah, but the money you're making has less value. What counts is what you can buy with your money, not how much of it you're earning.
Yeah, no kidding. That's funny. Somebody, I think there's a saying like, people are often asked, oh, would you rather have a 2% raise when inflation is 3%, or would you rather take a 1% pay cut when we have 2% deflation or whatever? And generally people always bias towards, oh, I want the raise, even though their purchasing power is evaporating.
Yeah, and in fact, if you go back throughout the 19th century, in America, where wages were relatively stable, people didn't get raises. You got raises, obviously, as you gained experience and you become more valuable, right? So because now you have higher productivity, so you can command a higher salary. But let's say the base wage for entry-level positions kind of was steady, but prices were dropping like 1 or 2% a year for 100 years. So real wages were going up, even if nominal wages were not. Real wages were, and that was what really built the middle class. Was that the money you earned bought more and more stuff because the dollar's value was going up as American productivity was increasing their value. But the government destroyed that, robbed the public of that benefit by creating all this inflation. And so rising real wages are a thing of the past. Now you get rising nominal wages, but in real terms, people are making more, but they're actually earning less in terms of purchasing power.
Wow. I want to ask you this. What happens in this scenario in Peter Schiff's world if we have, let's say, used car prices on average go from $100 to $140 this year? That's 40% inflation. But the next year they go down to 131% or something like that, $100 or $132, whatever. And all of a sudden we looking at, wait a minute, we just had, I don't know, 2% or 3%, 4% deflation in car prices. We're still way higher than where we were, comparing to 2020, but all of a sudden in 2022, we had deflation compared to 2021. Is that possible? What happens in a scenario like that? Does the Fed just keep cranking the money printer?
Well, that's what they're hoping for, right? That some of these big price increases turn down. But look, even if we get a slowdown in the rate of appreciation of used cars, which we probably will, I think they're still going to get more expensive. They're not necessarily going to get cheaper. They just won't get more expensive as the same rate. But remember, there are a lot of other products that are going to pick up the slack, especially housing. I mean, again, think about housing. How much housing prices and rents are actually going up, and none of that is in the CPI yet. Wait until that stuff comes into the CPI. I mean, that's going to dwarf what's going on with car prices, used car prices. But the new car prices, they're going up a lot too, especially too. I mean, if the used car prices are going up, that means car prices. I mean, new car prices are going to go up too, a lot. I mean, the reason that used car prices are going up is because there aren't enough new cars to buy. So new car prices are going up too. But a lot of times too, I'm not really sure how much the new car prices are actually captured in the CPI, because the new car prices, they come out with a sticker price. Yeah. And normally people get to buy them well below sticker. But let's say now no one's buying below sticker. Maybe people are forced to pay the sticker. According to the government, well, the price hasn't gone up because the sticker prices are the same. But if people were buying, 5% below sticker and now they're paying sticker, that's a 5% increase that's not captured in the CPI.
That's interesting. Okay, so you're saying they're measuring CPI not off what people are actually paying versus what they are paying now, but maybe off.
I think it's based on,
MSRPs.
Again, I don't know for sure. I'm just guessing at what they would do is because they would look at the manufacturer suggested price and compare it to the suggested price from before. I don't know that they're actually getting down in the weeds and seeing, hey, what was the actual sale price of these cars? And the CPI is always rigged too. I mean, they always come and say, oh, the cars are better because they don't pollute as much. Yeah, well, who cares about that? I mean, most people buy and they go, well, it's okay that I paid extra because I got fewer emissions. I mean, most people aren't looking at that as a big perk. But if they but the government says, oh, you got a better deal because you have fewer emissions. So, but there's all sorts of ways the government is claiming that things are getting better. I don't think they ever admit when things are getting worse, when they substitute lower quality ingredients, cheaper materials. Or, I read another article today where they talk about shrinkflation, where, hey, they didn't raise the prices, but they just, put fewer flakes in the cereal box. This one article that I read, not only did they take, I don't know, maybe 8% of the cereal out of the box, but they actually made the box bigger, just so they really fooled people. It's okay, look, we're going to take cereal out of the box, but we're actually going to make the box larger than when it had more cereal. But, there's a limit to how often, how much they could do that, right? They can't sell this gigantic box of cereal that takes up your whole car and it's got one serving in it. I mean, they can't start selling toilet paper by the sheet. I mean, right now they keep, they take away 20 sheets, 30, instead of raising the price. But, at some point there's a limit to how small they can make stuff, but I don't even know if the government are they looking at how many cornflakes are actually in the box, or are they just looking at the price? I'm not even sure if they're looking at the unit price.
It's a good point. I want to ask you about the quality argument, because you've mentioned this before, that and this is it's a good argument that, hey, if we used the data from the 70s or the same methods of collecting inflation data in the 70s, inflation today would be way higher. But as
much
time goes on, they keep changing what's in the basket, so it's kind of a messed up measure. Now, I want to ask you this: is it possible that they're doing that? Because maybe 10 years ago, I needed to spend $1,500 to have the iPad that I wanted. But now I could get the iPad that I want for $500, and the $1,500 version just has, I don't know, 3 more cameras on it, but I don't need that version. So is it fair for them to make those sort of deflationary adjustments, or is that just being done to rig the game?
No, I don't think it's fair, because, stuff is always getting better in technology terms.
Sure.
I mean, stuff was getting better in the 1970s, but they didn't take that out of the CPI back then. But the thing is, if I wanted to buy the computer from 10 years ago, I can't. It's not on the market anymore. It's like you have to take the better one. It's like you don't have a choice that, if I don't want all the extra memory, I don't want all the extra speed. I mean, at the end of the day, it may not be that important to me as far as the quality of my experience, what I'm using it for, but I have no choice. I got to buy it anyway. And now the government says, well, even though you're paying more money, it's actually cheaper because it's so much faster. But, I can only type so fast. I mean, it doesn't really matter about some of these things changing. And, it doesn't affect me. But, where the quality reductions really come in is the material quality, where they substitute cheaper vinyls or plastics for what used to use leather or something like that, or had more steel, and now they've taken a lot of that away in the cars. What really bothers me on quality is, let's say you buy something, right? And it's a piece of furniture, right? And you buy this piece of furniture and it was made in China. Whereas, 10, 20 years ago, maybe the piece of furniture was made in America, but now it's made in China. And it's a little bit cheaper or the same price. But when it was made in America, it was fully made, and I brought it home, or it was delivered, and that was the end of it. I just, put it there. But it comes from China, this huge piece of furniture in a tiny little box with a whole bag of screws and instructions that you can barely understand. And so then it takes you 2 hours to put together what you just bought. Yet none of that is in the CPI. What is all your time worth? All the time that we spend putting stuff together, there's no, I mean, you should have to add that to the cost of the product. Or, how much time, I got to make a phone call now. I got to call up the credit card company. I got to call up an airline. I want to do something. I'm on hold for an hour, right?
Yep.
Because, they're trying to save money. They don't have as many workers. They don't have people answering the phones. And so you're on hold for an hour. So instead of raising prices so you don't have to wait on hold, they just make you wait on hold for an hour. That's not in the CPI. But what's your time worth, right? So there's a lot of things that are happening that are really raising the price, but it doesn't show up in the CPI.
I went on my first post-COVID flight and went to LAX. And the employees working in the airport were saying, we can't hire fast enough. There's so much demand. I get to the gate. They only have one person working at the gate. The flight gets delayed 2 hours because they can't get the other plane out fast enough. The engine can't start itself, so we have to wait for some box cart or whatever to come to start the plane. It's like I'm sitting here wasting hours of my time. I'm late for my commitment in the morning because it's a red eye. Don't get any sleep because I'm stressed. Like, I probably paid 10% more for the plane ticket than I would have last year.
Go to the post office.
But I just paid way more with my time,
I mean,
got
go to the
screwed.
passport office. I was at the passport office to get the passports for my kid. It's a nightmare. I mean, there's nobody there. There's nobody working there. The place is empty. Once you get inside, there's nobody there. There's a huge line around the block to get in. But once you get inside, there's no one working there. It's like a ghost town. But everything now takes forever. How much? You know how many COVID tests I take? Here when I'm here in Europe, they don't take my insurance, so it's $50 a pop. I got to take them for the kids every week. Now I realize I got to take the COVID tests to come back in the country. When I left the country, I don't think they Puerto Rican insurance. The U.S. charges $200 for a COVID test. I mean, where is that in the CPI? I mean, no one was taking COVID tests a couple of times. Now every time you want to do something, where's your COVID test? Even though I got a vaccine, they still want the COVID test. How much are we spending on masks? That's a good point. Right? I mean, people were spending zero on masks a couple of years ago. Now, how much money we wasting on masks?
That's a good point. Now, I want to ask you this. About 40 to 50% of people believe that cryptocurrency is an inflation hedge. Now, I know you don't love the idea of cryptos, but if the market, and I'm trying to understand this broadly, right? Because if the market is expecting large inflation, it's just odd that bonds are going down, the dollar's going up, and cryptos are falling. Like, those three things are all literally doing the opposite of what should be happening if we were to expect high inflation. Are they just all wrong?
Yeah. Well, Bitcoin's a little bit different than those assets. And first of all, Bitcoin is only an inflation hedge to the extent that, okay, there's a limited supply of Bitcoin, 21 million. There's an unlimited supply of dollars. So if we keep printing dollars and the demand for Bitcoin in real terms remains constant, then the price of Bitcoin should go up because the supply of Bitcoin has now decreased relative to the supply of dollars. But the problem with Bitcoin, and the reason it's not an inflation hedge in the sense that another commodity would be an inflation hedge like gold, or a real asset like real estate or stocks, is because there's no actual value in Bitcoin. It's not another good or commodity or asset. So it has no relationship to any other asset that you may want to buy in the future. So you can't hedge your purchasing power by storing it in Bitcoin, because Bitcoin may have no purchasing power, because nobody knows if anybody's going to actually want Bitcoin in the future. I mean, we know they want them now, because they think they're going to get rich. But if people stop thinking that Bitcoin is, a guaranteed ticket to riches, there may not be any demand for it. The other problem is that there is a massive supply of cryptocurrencies. The inflation in cryptocurrencies is bigger than the inflation in dollars as far as the supply. We almost have 11,000 cryptocurrencies now that you can choose from. And actually, the supply of Bitcoin now, even though it's capped at 21 million, I mean, they're inflating them. They're mining Bitcoin every day, or solving math problems to create them. So there is more Bitcoin being introduced into the ecosystem, and people have to be there to buy it. If they don't want to buy it, the price is going to fall. And so I think that, the Bitcoin bubble, there's a very good chance. I mean, obviously not 100%, right? I mean, I thought that 20,000 was the peak, although I knew it might not be, and it wasn't. We got to 65,000. So now I think that's the peak. And I think the odds that that's the peak are probably somewhat greater than the odds that 20,000 were. I don't know. But I think that if we crack this next, move down, and we go back, below 20,000, maybe below 10,000, it'll be very, very hard for Bitcoin to ever make a new high, I think. And then I think, everybody bails on it. It's going to have too many holes. Too many people have been burned. I think the institutions will be gone for good. Those that decided to play are going to lick their wounds and leave. Those who dodged a bullet are going to be glad that they never bought it. But you're not going to have that FOMO where people are like, oh my God, I better buy it, or I'm going to be left in the dust. Everybody's going to get rich but me. I'm going to get fired if I don't buy Bitcoin because I'm going to underperform. I mean, all that kind of FOMO stuff is going to go away after this next crash. And but people, yeah.
Well, what this blew my mind. Okay, so and I'm not trying to pat myself on the back for, on this at all, but I want to ask you why, because it's really weird. In January, I made this prediction that potentially, because of people's fear about inflation, Bitcoin would peak on April 13th and May 12th. Those were CPI release days. Bitcoin peaked on those 2 days. It's really, really weird. And so I want to know, what do you think that obsession is? Why is there such this weird correlation? Why would that happen?
Like I didn't see anything happen to Bitcoin today with the CPI. I think
Just fell
kind
a
of
little
like
bit, yeah.
it was about the same. Really, very little reaction. I was actually watching the market. There was an immediate reaction in gold and the dollar. There really wasn't a reaction at all in Bitcoin. But maybe on those other days there might have been. But to me, I think the peak in Bitcoin may have more closely correlated with Elon Musk hosting Saturday Night Live
Okay, yeah.
the inflation numbers, because this is all about tweeting and memeing, and there's no substance behind any of this. It's all hype, and the hype is gone. I think look at the Google search terms now. I mean, people are no longer looking for Bitcoin because the air's coming out of the bubble. The volumes are drying up. You still have the diehards that are hodling, and they're holding and hoping. But I mean, I would have to say that at this point in time, all the people, or almost all the people who want to buy Bitcoin have bought it. And the people who decided not to buy it don't want to buy it. I don't think there's like this whole world that it's like dying to buy Bitcoin. Why wouldn't they have already done it? I mean, it's not like they don't know about it. I mean, it's all over the place. That's all anybody talks about. So I think, everybody's on board. Even Tom Brady joined in and got laser eyes. And you got, I mean, it's so anybody who thinks they're getting in on the ground floor or something, buying Bitcoin now, it's crazy. I mean, so if I was interested in Bitcoin and wanted to buy it, which I don't, I would wait for a big collapse. I would wait for nobody to be talking about it. I would wait for CNBC to take the bug off their television like they did last time. They initially put it up there when Bitcoin ran up to 20,000. And then when it crashed, they quietly took it away and never spoke about it again until it was like 20,000 again, right? So wait until, because right now, every guest that comes on the show is asked about Bitcoin. Doesn't matter who they are, what their background is, they get a Bitcoin question, right? It's a must thing. So wait till they haven't talked about it for a month or two. Like nobody has mentioned it.
Wow.
The price will be, but the problem is if the price is really, really low, I mean, does anybody actually want it? I mean, maybe not, but this is certainly not the time to be buying a momentum asset that doesn't pay a dividend, doesn't have any income. It's all based on price. And, you've got everybody in there. And then look at the chart. I mean, the chart looks horrible as far as, the downside risk. I mean, the thing could fall through the floor here. It's got this gigantic head and shoulders. I mean, you don't have to be like a top technician to see this thing. And, it's a long way down from the neckline.
Jeez. So, all right, last two questions I have for you then. Momentum assets, like you just mentioned, obviously there's Bitcoin, there are companies like AMC, GME, all this. What do the next 6 months look like for momentum assets? Is this people go back to work, go back to normal, kind of forget about the daily life of investing in momentum, and does it just fade away, or is it just going to keep coming in these random phases?
Well, I mean, look, meme stocks are getting beat up for good. I mean, not for good, but for good reason. They haven't looked well recently. They've been going down. They have a long way to go down before they get to some type of fair value. And the fair value for some of these meme stocks may be zero because the companies may go bankrupt. So we'll see. Maybe the speculators can run them up again. I don't know, but it's not investing. All these guys are going to get slaughtered. Just like the crypto investors. It's unfortunate too, because the government regulators are going to come in, as they always do after all the horses have left the barn, and they're going to come in and try to shut the doors with a lot of new regulation, in the aftermath of all these losses. And the regulation is going to be counterproductive. I mean, there is stuff they could have done to stop some of this pump and dumping and some of the fraud that is actually going on in these markets, but they're kind of allowing it to happen. It's almost like they want it to happen because they want everybody to lose money so they can blame it on capitalism, and then come in and use the supposed failures of capitalism as an excuse to have even more socialism, which is what's coming.
Wow. Okay, that then brings up the last question, which is how much are you thinking? When we get this inflation, the market might sell off, and how do you prepare? What's the best way to prepare and invest?
I'm prepared. I mean, I am fully prepared for this because I own a lot of real assets. I own stocks around the world in countries that I think are in much better economic condition than the U.S. They will not experience anywhere near as much inflation as America will. So their assets, I think, will do better. But as the dollar crashes, in dollar terms, the prices of these assets are going to go way up, even more so than in their local currencies. And so will the value of my income. So I have a lot of good dividend-paying value stocks. There are still good values as people are chasing momentum and buying up these meme stocks and chasing the FANGs and all those kind of stocks. Where they've been getting the money. I mean, they've been selling a lot of these value stocks, traditional value stocks that pay good dividends and have good earnings. And those are exactly the type of assets that investors are going to want to take refuge in an inflationary environment. So I already own the assets that everybody is going to want to buy, and they're going to pay much higher prices to get them. I have a lot of exposure to materials, industrial, agriculture, metals, not base metals, but also, of course, precious metals. I do think that as a lot more people recognize the real inflation risk and that the Fed's going to do nothing about it, people are going to look for inflation hedges, and they're going to look at gold rather than treasuries or US dollars or Bitcoin. They're going to be looking at gold. And so I want to own that. But more importantly, I want to own the companies that own the gold, the mining companies. They have lots of gold reserves that today are being given no value in the stock price because it's too expensive to mine the gold. But when gold prices do what I think they're going to do, the cost of mining gold is really going to come down. And so their profits are really going to go up, right? I mean, the cost of mining gold is going to go up, but not as much as the value of the gold. So the delta is going to grow. So there's going to be a bigger profit. And so I want to own those stocks. And so I would certainly encourage, your listeners to, construct their portfolios, the way I'm doing it, to the extent that they're more risk adverse than me. Maybe they don't want to have as much in the way of gold mining stocks, and they want to have more just good, solid dividend-paying stocks, utilities, property stocks, telecom, tobacco, pharma, oil and gas. I mean, there's a lot of good quality companies. If you're more aggressive, I mean, if I was just a youngster, if I was in my 20s, I just want to go all in right now on the mining stocks. I'd put all my chips in that, because I think the upside there, I mean, I think there's some stocks, some junior miners that are going to 50x, 100x. I mean,
like Barrick Gold. I mean, Warren Buffett went in,
well,
and then he
Barrick
went out.
Now, Barrick's not going to go up. Well, if there's hyperinflation, but of course, then everything will go up. But I think a stock like Barrick can still go up 5x, maybe 10x. But the real big winners are these junior miners. But of course, for every big winner, there's one that could go to zero. So that's why I like people diversifying or hiring a professional manager if you're going to play in that space. And I hired Adrian Day to manage the mining portfolios for my clients, both through my mutual fund and for my separately managed accounts, because even I don't have the expertise to know, which of the junior gold miners to buy. right? I mean,
Sure.
so I hire Adrian because he's done it for 40 years, and he's, you know, I don't think he has anybody that could do it as well. So you can get Adrian, you can hire Adrian by buying my gold fund, the Euro Pacific Gold Fund. You can buy it, you know, any of these discount brokers. You could get it no load. You can work with my guys at Euro Pacific Capital or Euro Pacific Asset Management, and we incorporate those funds into our strategies. I have wrap accounts. I also have accounts where we'll manage portfolios for you without using a mutual fund. We'll just build you a portfolio of mining stocks, and then Adrian will manage that portfolio. But we also manage global portfolios, again, of dividend-paying stocks. This is what people need, especially if you're retired or nearing retirement. You have got to get your money out of U.S. assets, particularly fixed income, bonds, U.S. dollars, because if you don't do that, it's your money that's going to retire, not you. You're going to have to live. You don't have to work for the rest of your life because the money you saved is going to disappear in terms of purchasing power. So if you don't want that to happen, you've got to build a good defensive portfolio of non-U.S. assets that will throw off income in currencies that will appreciate as the U.S. cost of living is going up. So people, you know, you can contact, you know, my guys at Euro Pacific Capital, Euro Pacific Asset Management, and talk to us about, you know, creating a portfolio, or you can do it yourself with my mutual funds, you know, at your discount broker. You know, I have a whole family. There are 5 funds in my family. I've got an emerging market fund, and I think the emerging markets are going to do extremely well when the dollar tanks. And I've got a global value fund, a dividend payer fund, and even a foreign bond fund, which is low maturities. If you just want to park some cash, you're not really sure what you want to do. You don't want to take, you want to have some dry powder. That's where you should keep it rather than in U.S. cash.
Wow. Wow. Well, gee, thank you for that. Gosh, I mean, that wraps up the questions I have for you. I've linked Schiff Gold and Euro Pacific Fund down in the description below. Anything else you want to add, Peter, time-wise, or anything we didn't talk about?
No, I forgot to mention. Yeah, I forgot to mention Schiff Gold. Thanks for mentioning that. But yeah, get yourself some gold, get yourself some silver, physical stuff, the real deal, by calling Schiff Gold. So yeah, for sure, do that. I mean, that's real money. I mean, we may be, you know, using that one day again, like, you know, like our great grandparents are all carrying around gold and silver in their pockets. We may be doing that again. You know, our great grandparents did it. Our grandkids might.
Wouldn't you say though that would probably take a complete collapse, like worse than the Great Recession, to get to that? Huh? But that's also what you're expecting, right? Oh, I think I lost Peter at like a good question. Darn. My assumption is that the answer would have been yes. That's and this is something that he talked about earlier, that the crisis that we're in has only gotten worse from the last recession. So it's an interesting argument. But yeah, somebody was asking me the other day, Kevin, are we ever going to go back to the gold standard? And my expectation is that in order for us to go back to any kind of asset-backed monetary system, probably have to have the mega epic of all crashes, you know, something either between the level of the Great Depression and the Great Recession, or even worse than both of them, is an expectation now. You know, odds of that happening, well, I guess we'll see. So, well, we're going to wrap it up there anyway. So, folks, thank you so very much for coming and joining, and we'll have to leave it to your imagination, or leave a comment down below. Let me know. What do you think Peter would have said? And folks, we'll see you in the next one. Thanks for watching. Bye, everyone. Oh, wait. Peter's back. Hold on. Wait.
Yes.
Peter, what would your answer have been?
What was the question? What was the question?
What would it take to go back to the gold standard?
Well, it's just going to take a currency crisis, which fortunately one's coming, you know, because the politicians are never going to voluntarily give up their power and return to a gold standard. I mean, in fact, we're getting close to the 50-year anniversary. It was August 15th, right about a month from today, almost 50 years ago, that Nixon took us off the gold standard. And if you remember, or you don't remember, but you can read about it, when Nixon signed the order to take us off the gold standard, he said it was temporary.
Oh,
right?
no.
So he didn't say he was doing it. Now, of course, nobody believed it would be this temporary. It was temporary, like inflation is transitory, right?
Oh,
So we're going to go back. But the reason that we left the gold standard in the first place, it's not that the gold standard didn't work. It worked too good. That's why we went off it, because the politicians had a choice in 1971: cut government spending or go off the gold standard. So they chose to go off the gold standard because they were running these big deficits and they didn't want to balance the budget. Now, they also could have raised taxes dramatically, but they didn't want to do that either. They wanted to keep printing money, and gold stood in the way of doing that. So instead of acting responsibly, they went off the gold standard. It's like, if you think about gold as the chaperone at a high school prom, and so the kids wanted to all get drunk and do a bunch of stuff, and so they took the chaperone and they tied him up and they stuffed him in a closet, right? That way they could get away with whatever they wanted, and so they're not going to voluntarily, let the guy out of the closet. The parents would have to do that, right? Not the kids. So the government is never going to go back on the gold standard unless they have no choice, because the public demands it, and because the public loses confidence in the money they're printing. And so once nobody wants the money they're printing anymore, then what good is it? So now they got to do something to reinstill confidence, and the only thing that's going to do that will be to back the dollar with something real, and so what are you going to back it by? So they're going to back it by gold. So I think we will go back to the gold standard. Remember, the history of the world, and that goes back for thousands of years, is on a gold standard. I mean, that is what we've done. Now, throughout history, there have been examples of time periods where nations have tried paper money. We didn't invent it. It's been around for hundreds and hundreds of years, right? I think the Chinese invented paper, but it didn't take long for the government to try to make it into money, right? Because they could print it. So ever since they've had paper, governments have experimented with paper money. But every single experiment has failed, and every paper currency that was ever created went to zero. And the country that used paper went back to gold. So what we've experienced over the last 50 years is the exception, not the rule. The only thing that's really different about what's happening now is that every country has making the same mistake. We're all running the same failed experiment together. So,
but this time's different, Peter.
Well, that's the only thing that's different, is that more people are making the mistake at the same time.
I see.
But the dollar is not going to be the first fiat currency to succeed. It's just going to be the next one to fail, or eventually.
Very last
we're
quick note.
going to go back on a gold standard, but the key is buy your gold first.
Yeah. Do you think this is worse than the Great Recession, worse than the Depression, or somewhat in between, or worse than both?
It will be worse than both. And in fact, the Great Recession would have been worse than the Great Depression had the government, let it run its course. But, the reason we even had a Great Recession was because of the government. I mean, the government made depression. The depression was a depression because of the government. If it was up to the free market, have you heard of the Great Depression of 1920?
Of 1920, so before 29. Can't think of it right now.
Yeah, because it didn't exist, because the government didn't do anything about the recession that started in 1920, which actually started out worse than the one that started in 1929. We had a bigger drop in GDP, a bigger drop in employment at the beginning of 1920, but the government did nothing. In fact, the government actually cut government spending into the recession, which is why it was so short, because the free market got us out of that depression before it really got started. And then we had the roaring 20s. The government, it was Hoover who intervened, and then Roosevelt, who doubled down on Hoover's failed policies. They combined to create the Great Depression. We didn't get out of the Depression until we ended the Second World War, and the government finally started to cut government spending. So the government created the Depression. The depression that we're headed to is also a creation of government, except it's going to be much worse, right? Because the government is far more destructive today than it was back then. And the U.S. economy is in much worse shape today than it was back then.
Wow. Wow. Well, there you go. Thank you, Peter. I appreciate this. Well, I would say this is a perfect spot to end it on. I meant to end it right when we got cut off the last time. But I really want to thank you for your time. Links down below.
Well, storm. I don't know. Did you see that? Did you see that lightning bolt? I was looking. I saw the big lightning bolt.
For me, it's overexposed, but I believe you.
Oh. Yeah,
Peter,
but don't forget, listen to me on Schiff Radio, schiffradio.com, my podcast. I got another one coming out tomorrow. I'm still doing them, even though I'm in Switzerland for the month. So
good for you. Oh, that's awesome. Well, enjoy Switzerland. Thank you so much for coming on. Check out Peter Schiff on social media. And Peter, we'll see you in the next one.
All right. Take
folks.
care.
Peter, stand by for one moment. Everybody else, thanks for being here. And we'll see you in the next one. Bye.